We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Steve St. Angelo of the SRSrocco Report. Thanks for joining me today, Steve.
Tom, it's great to be here. It's been a little while and a lot of things have changed. So it's good to talk about the energy cliff, the dynamics, and the precious metals.
Absolutely. You know, there's so much to get into here today. But I wanted to start by asking you how you got into precious metals. You know, you're very heavily focused on energy. And I was wondering if you kind of came to, as you put it, the highest form of money or the highest form of collateral through understanding this from an energy perspective.
Well, I've said this several times, but it's good. It's worth repeating. I got into the metals just like everybody else, and that was due to the printing of money, the debasement of fiat currency, the increase in debt, and I found out about silver actually from reading Ted Butler early in the late 1990s and early 2000, and I started buying silver like in 2002. So I've been in the silver market for like 20 plus years. But as time went on, even though I read a lot of the analysis about the precious metals, some things didn't make sense. Why was it trading the way it was? And so then I found out there's cost of production, Tom. And so what drove the price? Why did silver and gold come down and hit these levels and go back up? And it turns out to be that's the cost of production, the total cost of production. So I've done 50-year charts showing that that's kind of the case. So you get speculation pulling the price above that. And so it was all about the energy, not only the cost of oil, but cost of labor, cost of materials, all that goes up when the oil price goes up. So then I was interested how energy drove the economy. And so when we find out that energy and GDP are directly related one-to-one, that's all we need to know. And unfortunately, the economics profession totally ignores energy. And so this is the reason why I still believe in precious metals to be the best assets to own. But unfortunately, the market thinks we're going to have growth forever. And that all those other assets like stocks, bonds, and real estate, which continue to be highly inflated, they only work as energy production increases. So when we see that this is going to start to decline, we need to understand that the entire market as we know it is going to profoundly change. And most investors are not prepared for it, Tom.
You know, I had a conversation with Luke Groman a couple of weeks ago, and there was one of the comments that he made was assume a can opener. And I saw that you had kind of responded to other times that he had said that. So is this the argument that's being made about growth and continuing growth? That's assuming a can opener, assuming, at least this level, if not better, energy going forward.
Tom, we could talk about that for an hour and a half, just on this is what it comes down to. There's the peak oilers and the anti-peak oilers. Mm-hmm. And without oil, we don't get to increase the coal, the production the way it is, or natural gas, or these other energy sources. So oil is the number one. So there's this anti-Malthusian debate that's going to continue. Unfortunately, when you look at the thermodynamics, which is also excluded from the economic theory, what I find interesting, Tom, is those who really are smart about economics, whether it's regular economic theory, classical economics, or Austrian school of economics, they tend to forget or don't understand physics, the laws of physics and thermodynamics. And so when we understand that these things do peak and there's a falling energy return on investment, we're not going to have the continued growth. And when you look at the real numbers, you can start to see that. And so, yes, the world believes there's going to be growth forever. But when you look at the past civilizations, that was never the case. They went up, they built too high, they collapsed due to they went above the carrying capacity of the resources. And we have just done it on a global scale.
So, Steve, let's revisit this idea of the cost of production for both gold and silver. What do you see that now as the actual cost average across the industry, and how that affects, let's say, the day-to-day price that we see?
Well, my last analysis, the total cost of the primary silver miners, which now they only produce about 30% of silver, but their cost is between $21 and $22 total cost, everything. And the gold miners, it's about $1,550 to $1,600. Some gold miners, it's less, and some gold miners, it's higher. Now, if you look at the base metal mining that produces a lot of silver, if it's copper, their cost of production has gone up considerably. So, like KGM Palisade is the largest silver byproduct producer in the world in Poland. They produce 40 million ounces. That's byproduct. However, they're barely making money producing copper and silver, so they're not giving their silver away for free. So I look at that as break even too. So again, 21, 22 silver, 1550, 1600 gold. These are the bare minimums now to continue producing the metals. So this is where I see the low case for these metals.
So do you see this dynamic changing? Basically the basis of cost driver for the metals. Do you see that changing because of these energy dynamics, or let's say financial market stress? If we see another set of bank failures, or some type of general market collapse that starts to drive a lot more people into the precious metals, do you see that driver of the cost of the metals changing?
I do see the driver. I don't see much of a decline in the price because we have gone through the good quality reserves, and now we're basically mining gold dust at about 1.2 grams per ton. And the silver ore grades and the primary miners have fallen by 50% in just in the last 12 years. So it's not going to get cheaper. It'll just get more expensive. Mm-hmm. That isn't going to be the basis of the value of gold and silver. It would kind of be the floor. The basis will be when we hit this energy cliff and we start losing oil production. That means we're going to have falling metals production, gold and silver. On top of that, the highly inflated Ponzi financial assets only can continue growing if you continue increasing energy. When it starts to fall, Tom, it all starts to fall apart. So just getting a few percentages of very smart institutions, high net worth individuals, realizing they have to protect their wealth, they're going to be starting moving into precious metals because they store this, I call it this energy value. They don't store energy, they store energy value. And so this is how I see it transitioning in the future. And again, the market continues to not understand these dynamics. The first warning sign was the energy cliff hit Europe, nat gas, 2021, 2022. They've been lucky, they've survived it, but they're going to go through round two again, and either the end of 2023 into 2024. And this just continues for the rest of the world with oil and natural gas and even coal. And so these are things we need to understand that are just going to continue to hit the global economy in the years ahead.
Mm-hmm. Steve, you bring up an interesting point about, in a way, the transition of building wealth to protecting wealth. We've had 40 years of lowering interest rates, and now we're in this higher interest rate environment. And combining that with the picture that you foresee not too far down the road of this energy cliff, is this a real, transition point where people aren't going to be so concerned, people and institutions aren't going to be so concerned with building wealth, but more so protecting wealth?
Yes, typically the growth in the world is based on oil production growth. And it's averaging about 1.2% a year. Now, back in the 40s and 50s and 60s, we're talking 5, 10%, 6, 8% some years. So we had a lot of growth during those periods. Now we don't have much growth. And basically the 2% Fed interest rate, that's what they shoot for, the inflation rate, that's based on the 1 to 2% oil production growth. The issue is now when that production starts to decline, what that's going to do is it's going to really start to impact the dynamics of the situation. And I've lost my train of thought. Would you repeat that question again?
This transition of building wealth versus protecting wealth.
Okay. I'm going to make a presentation, and basically you can build wealth when energy production grows. And let's say the overall economy, the overall market, most participants, like Robert Kiyosaki talks about, you use cash flow, you get someone else to pay the mortgage, and you get to be the owner of the real estate in time. You own it right out. And this is true with businesses and commercial real estate. The problem is that doesn't work when energy production grows, because then when you have declining energy production, a lot of those houses that you want to rent are going to become vacant. And the market isn't prepared for that yet. So you're going to have people move into home, families move in together just to survive the stagflation that's coming. And so in that, when we transition, and we're just in the beginning stages of that transition, I say that the energy cliff begins about 2025, plus or minus. And then as time goes on, it's going to be higher prices and it's going to be less growth. And that means people are going to have to start really protecting what they have. The smart ones will. A lot of people are going to lose their wealth. And then we're going to get cliff-like declines in energy production. And that's really going to hurt the asset values in the world. And so this is how I see it playing out. So the smartest, wisest investors will start transitioning earlier on than the rest of the market.
Steve, I'd like to spend a little bit of time talking about silver here.
Sure.
We have this, major industrial demand at this time, and every year we see a production deficit, right?
Yeah.
So, at what point do you think that starts to matter, and at what point do these other demand pieces start to come in from the investment demand, the institutional side?
Mm-hmm.
These other pieces of the puzzle that really should be making a difference in the demand for silver.
Well, let me start off by saying I have a little bit of a different way of looking at the silver and gold market than many of the precious metal community, because it has fundamentally changed in the last 15 years. We didn't have any ETFs about 15, 18 years ago. Now we've got many of them, major ETFs, the silver ETFs, the gold ETFs. So there's a lot of silver and gold now in these ETFs. So what we've seen over the last decade, when you see major flows of metal into these ETFs, it tends to correspond with the market price of gold and silver. I'm not saying 100%, but it does it much better than retail bullion buying. And so when we understand that there's a lot more silver held in these ETFs, in the silver ETFs, we need to look at the market differently. And right now, there's really no demand for silver bullion. That's why premiums have collapsed in most of the bullion, coin, and bar products. Same thing with Indian demand. Indian demand is typically average, 5-year average. They're importing 500, 550 metric tons. They didn't even import 50 tons in June. Last year, they imported almost 1,000 tons. So what we see is the Indian demand is gone, and also institutional demand, Tom, is gone, because we had a lot of institutional demand and demand move into flows into the ETFs during the Russian-Ukraine war, but that has been coming down ever since. And so we haven't really seen a lot of net demand or flows of silver into the silver ETF, the SLV ETF. So when you don't have those three factors, what has been the saving grace has been the industrial demand, which is a lot of solar now too. A lot more solar has been used, a lot more silver and solar. So right now, I think due to the higher interest rates, we're seeing institutions move out of gold and silver. Indians aren't buying because it's higher for them. They tend to buy lower. And they're
very price sensitive, right?
They are very price sensitive. They look for deals. And so right now, we don't have the top three demand. It's gone. We only have industrial demand, and that is kind of strong. However, I see a time when we get those three coming back in all at the same time, and that happens as the stagflation and the energy problems really start to hit. That's when we're going to see, because people don't care about deficits unless they impact the price. That's when they'll impact the price, and I see that beginning to happen in the next several years.
So, Steve, what factors do you think bring institutional demand back in a big way here? Is it just momentum and outperformance of that particular commodity versus, let's say, more mainstream indexes that forces institutions and or hedge funds to rethink their vehicles of choice?
Yeah, we need to understand. People think the ETFs are a scam. Now, there are probably issues with these ETFs. There's all this silver there. The thing is, if you and I want to buy silver, we call up a dealer and we buy it, and we either get it shipped to our house or it goes to, let's say, a private vault. If we're buying a pretty good amount of silver, well, if you're a fund manager, an institutional manager of other people's money, you don't do that, and you don't buy futures. So the only way you're going to get really to get exposure to silver is through these ETFs, and it's very simple. You want to put 50 million in, you do a click, and you get access to silver through the ETFs, and that's kind of why they were designed. They were designed for this kind of institutional and high net worth demand, as well as retail demand. Now, what's different this is what's fascinating, Tom. When we had the Russian-Ukraine war, the gold and silver price shot up. We had net outflows in the beginning stages of silver out of the SLV, but in the GLD, institutions were moving metal into the GLD. Gold tends to be a little bit different with fear. However, both gold and silver in the last, especially during the pandemic shutdown, when we had the pandemic shutdown, a lot of institutions moved into the ETFs. A lot of silver flew into the ETFs. So I see we get more banking problems, and I don't think they've gone away. We get more banking problems. We get problems with stagflation. And let's say, I think we're going to see higher oil prices, going to be high CPI at the end of the year and into 2024. The Fed may have to raise interest rates. And then with our interest on U.S. debt now reaching $1 trillion a year and the debt increasing so much, I think we may start to see more institutions realize this is problematic, because Blackrock is the biggest holder of the Sprott PSLV now. They are the largest holder of the Sprott PSLV. They didn't go into their own SLV. They went into the PSLV. So just if we get more of that, and we will, that's when I see significant price moves in silver.
So, Steve, part of measuring the market and trying to understand the market is sentiment and trying to figure out what, let's say, smart money versus, let's say, just dumb money is doing. So how do you measure sentiment right now in the S&P, and what is the smart money versus the dumb money doing?
Well, I subscribe to Sentiment Trader, and they've got a lot of very interesting charts looking at the markets. And one is the smart dumb money confidence level. And when we see the S&P go up, most of the time, recently it's been what they call the dumb money. In retail, they have these different analysis that they use. So it's interesting, the dumb money confidence goes up with the S&P, and the smart money confidence tends to go down. And so right now, even though the markets went up again today, there's a huge disconnect between the smart and dumb money. The smart money is at a high. I mean, the dumb money is at a high confidence, and the smart money is at a low. Now, that doesn't mean the markets can't go higher. And Tom, I think the reason why the markets are actually still going higher, we just add $1 trillion in the U.S. debt because we had the debt ceiling, right, up until June. I think it was June 2nd. Then they had borrowed and pleaded and stole money to run the government. So in a month, the U.S. debt went up $1 trillion. Well, how do you get that? How do you fund that debt? You add $1 trillion in treasuries. So the money supply has been going down, but we noticed, if you look at the Fed data, the money supply has been going back up in the beginning of June. And we haven't even seen what that's going to be in the whole. It was only, I think, June 6th. What happens at the end of June? I think the money supply is going to continue to go up. So I think what's happening, this is also part of the dynamic that's playing into the bullish sentiment going into the markets. So even though dumb money continues to be at a high and smart money is at a low, the markets can continue higher. But I do think we're going to see a correction at some point here. And the metals have been going up with the markets too at the same time.
Yeah, I think the correlation between highs in the dumb money confidence, as per that chart that you posted, versus lows in the smart money confidence index are fairly correlated to corrections, as you put it, right? Smart money is out when the corrections come.
Yeah, smart money tends to buy at the bottom. Dumb money tends to buy at the top. So nothing changes. And so this is why these dynamics continue. And you would think they would learn, but they don't, unfortunately.
So, Steve, one of the terms you've used here a couple of times is stagflation. Can you quickly define that for us and explain a little bit about how you see those dynamics working?
Well, stagflation is very little economic growth and no economic growth, but higher prices. And we had that in the 70s and early 80s. And so I think what we're going to face due to the inability for the world to increase oil production, because that's where the growth comes from. You don't get the growth by adding debt. You get the growth by adding the oil. And so we're not going to have much oil growth. So we're not really going to have the growth there. But the market is going to start to understand that there isn't enough supply of oil. Even though in recessions we do get falling demand for oil, there's so many other countries, like I've said this, I put this tweet out, Tom. India had the highest consumption of petroleum products in May 2023. They're getting a lot of it now from Russia. Russia's happy to sell it to them. And so while the West might be impacted a little bit by the recession, India is not. And so when we understand there's a lot more BRICS, the other economies that are starting to grow from within, then they're going to consume more energy. So I think we're going to have higher oil prices, higher CPI, and we're not going to have the growth. So that is stagflation. And I think we could see serious stagflation in the coming quarters and years ahead, especially when we hit that energy cliff, because then I think they're really going to have to print the money or do the QE, because that's the only thing that's going to really keep the system from collapsing. That's what they're going. I believe that's what they're going to do.
Mm-hmm. Steve, are there any examples of past recessions, let's say, where a high oil price affected the economic activity negatively? It intuitively makes sense that the oil price should be negatively affected or go down in recession because of lack of demand. But what if oil prices are high?
Yeah, and good question, because I had a tweet with Jeff Snyder, and you've interviewed Jeff Snyder. He does a great job on the euro dollar and all the financial workings of what's happening in the market, and it's great work. And so he had mentioned in a tweet that the reason why we had high CPI after World War II, 1946 and 47, and then we went into a recession, was due to the savings of America had been depleted. That's partially true, but what Jeff failed to include in his dynamic was that the world was waking up again and consuming the oil. Oil prices went up 70% from 1946 to 1947. Well, that shot the CPI up. Now, what's interesting, in 48, it went to $1.90 in 47, up from $1.12 in 46. Then it hit in 48, it hit $1.99. But it started to decline in 99 and I'm so sorry, in 49 and 50. And that's when we had the recession. So you had basically the year-over-year growth of the oil in 49 and 50 was declining. And so, but the price in 50 was still $1.75, much higher than $1.12. And so we saw the same thing in the 70s. We had a massive increase in the oil price. We saw the same thing in the recession in the 2008 due to oil going up to 146. And now we were hit again when oil prices hit 120, 125 last year, really destroyed the European economy with the natural gas being so high. So yes, we have seen this over and over and over. And I have a chart showing that the CPI hit a high in 9% right with the US oil price. So the oil price is a pretty good indicator of how it's going to impact the CPI. And I think we're going to have more inflation coming.
Mm-hmm. Well, to that point, Steve, how and when do you think this energy push inflation starts to play into the picture in today's scenario?
Well, in some of the analysts I look at, Eric Newdall is pretty good. Maybe you should have him on as a guest. He looks at energy and what these different analysts are showing, even the IEA, is that demand is actually going to be higher in the third and fourth quarter. Bernstein research shows that demand is likely going to be higher for oil in the third quarter and the fourth quarter. It's going to be little surplus in the first quarter, but then they forecast more demand in the rest of 2024. When this has happened in the past, you've seen a $20 to $40 increase in the oil price. And so if this analysis is correct, and I think it is, because the SPR, they're going to stop selling oil from the SPR. And so if that is correct, it's going to be inflationary for the oil price. And so I think we're going to see oil prices move back up to 80, 85, 90, and even natural gas prices. But there's this situation with natural gas is a little different than oil. We could talk about that. But if oil prices go back up, that impacts the price of food, that impacts everything. And so that's going to impact consumer price inflation.
So why do you see that there are two stages to the energy cliff?
Well, we could see it perfectly with Europe. And I've mentioned this to you. Europe hit the energy cliff first because it's the largest net importer of natural gas in the world. I think in 2021, 35 billion cubic feet a day of net imports. Asia comes in at number 2. And Tom, everybody else is even, all the other regions of the world, or they're exporters. So if there's going to be problems with natural gas, Europe's going to be the first one to be impacted. And what did they do? We had shortages and high prices. Then they did the exact what we expect them to do. It destroys the economy. The industrial production in Germany has fallen 20% still. So it impacts that. And then they try to transition to other forms of energy like burning coal or burning wood. And so they've really cut down demand, consumption of natural gas. And they've kept the production, the imports still very strong. And so what you have now is Europe is sitting on record high natural gas inventories. And I think that's going to continue. If that continues, we're going to have even weaker natural gas prices. So it's high prices and shortages, followed by lower prices and surpluses. And then it goes back. And I see this transitioning back, even with oil and natural gas, into the end of 2023, or at least into 2024. These dynamics are going to change because we're starting to see supply now from the United States shale gas is going to start coming down. And so these are the dynamics that are going to happen. It's not going to be high prices all the time. It's going to, and that's volatile, and that's not good for the economy, either for producers or consumers.
Well, you've made that point to me many times before, Steve, the idea that volatility increases the closer we get to this energy cliff.
Exactly.
And go ahead.
And just perfect example. And I've said this over and over, but it's important because I looked at it again. The production of oil in the world increased 24 million barrels from 1960 to 1970. Tremendous amount in that decade. The price of oil remained at $1.80 because we were bringing all this oil, especially from the United States and Middle East. And so they kept the price at $1.80. And that's with all the geopolitics of the Cuban Missile Crisis and all these events that we had. Now we don't have that growth. And so any geopolitical events, and we could see even higher energy prices if we get some geopolitical events that, could make the situation worse. So that can only make the situation worse for the oil price or for the natural gas price because we're so tight now with supply and demand.
Mm-hmm. Well, considering what a warm winter that Europe got last year, and then, the complication of the Ukraine war, they made it through the winter without much issue, really, despite lower inventory levels of natural gas. So is it possible that they have, logistics better managed this year along with inventories to manage an average winter, let's say this year?
No, because I looked at 2022, their net imports did fall from 35 billion cubic feet a day in 21 to I think 28 billion cubic feet a day in 22. And it's about the same now. But if they have a cold winter, then that will disrupt things. And also, solar and wind, green energy outperformed in the end of 2022 and into 2023. That was the exact opposite for the year before. And so everything was pointing in the wrong direction for Europe a year ago. And now it's kind of pointed in their direction. And this is all the stars got into a line. And so now the inventories are at record levels. So we have to see what happens towards the end of this year. But I think Europe is going to get into trouble again with natural gas because they continue to shut down nuclear. They continue to add more wind and solar. And that only will impact how much natural gas they're going to need to generate or to power again in the future. So I think they're stuck on this path. They're stuck on this path of more problems with natural gas and energy in the future.
Steve, do you have any feeling as to how long those inventories, if they don't get any new imports, can last them? I remember going through some of these numbers, I think with Doomberg, and there are countries that only have a couple days worth of inventory on hand to be able to store in their country.
Yeah, and Tom, what's fascinating, it's good to understand where we came from, and we really can't go back to it, but where we came from when the economies were smaller, we used coal. We used coal to generate power mostly, and oil. That was very stable. And we had a lot of coal, and a lot of these coal-fired plants had 3 months worth of supply right there at the plant. So they just put it into the coal-fired plant, and then they would get shipments, rail or barge. Now we're moving away from coal in the Western countries, not China. China is producing more coal and consuming more of it than ever. But Europe has been reducing coal, and the United States has, and they're making it up with natural gas. So now they got to get that natural gas, not from Russia anymore, which is piped very cheaply. Now they've got to get it from the United States or from Kuwait or wherever, North Africa, and they've got to get it shipped through LNG in different areas. And this is just in time. So you're right. I don't know how long the storage will last if supplies just stopped, but it's probably in the matter of weeks. And so this is the issue the market doesn't realize. If we have some profound, who knows, we have a real pandemic and they really have to shut things down. We have no idea how this just-in-time system of running the world's electric systems now, how that could really break down. So this is, we continue to move forward, business as usual. But if we have any major disruptions, geopolitical or whatever, it could really disrupt these markets. We could see very high prices. And that's very disruptive to these economies, especially in Europe. And unfortunately, I think Europe is in serious trouble. I think the best days of the European economy are behind it, unfortunately.
Well, you talk about the prices that we've seen at these levels. At the beginning of the war, it moved a bunch higher. Of course, again, seeing the volatility that we've seen around when in March, when oil hit March of 2020, when oil hit a negative number. This is just, it's so crazy to see these fluctuations. But do you think this current level of oil prices have lulled the markets into a false sense of security for costs moving forward, especially if we do see a recession here?
Yes, because what we're seeing is, and the forecasts are the inventories are going to really start to decline. They built in the oil inventories, petroleum inventories, really built in the last 2 quarters. And so what's going to happen if this analysis, I'm correct, we're going to have more demand, they're going to really start to decline. And we've had the SPR. And so we're not going to have that. And so what's going to happen is we're seeing oil inventories, diesel inventories in the United States, gasoline inventories, they're below the 5-year averages. The exact opposite with natural gas. So that's the reason why natural gas is weak and oil is strong. And so I think that those dynamics are just going to continue. I really think natural gas prices are probably going to be weaker if we start getting even more inventory builds until October, November, and then it changes. But if we have a very hot end of the summer, that could change it a little bit. But I think oil prices are going to move up. And I think the market, right, I think they're underestimating the demand that's coming around the rest of the world. More countries, more third world countries are just consuming more energy. And this is not really appreciated by the economists, I don't think.
Well, Steve, oil and natural gas prices tend to move pretty much, in unison. Is the reason for this disconnect currently because of the inventory levels?
Well, if we go back and look at what's happened with natural gas in the United States, before shale, they tend to move together because that was more conventional natural gas. As soon as unconventional came on the market in the United States, it changed the dynamics. We had $2 to $4 natural gas from like 2010 to 2020, 19. It was very low, and then when we had the problem with the pandemic, and then the European crisis, then the natural gas prices really took off. And so the problem is now, how much supply does the world of the United States have? And the United States has brought a lot of shale gas on. And so I think the issue is we're exporting a lot of natural gas as LNG, and we're also exporting a lot of oil, tight oil. This starts to get into trouble in the following years. And so I think we're going to get back to that relationship: higher oil prices, higher natural gas prices. But right now, it's a bit different due to these fundamentals, because you could bring on a lot of natural gas. Not only do you get natural shale gas from shale gas wells, we get a lot of shale gas from shale oil wells. And so right now, there's actually kind of a glut of natural gas and storage in the market. But that all changes again in a very short period of time. I think towards the end of this year.
Mm-hmm. As we talk about the shale oil industry and the current price levels, do you think the rig count should be climbing in the US, considering this relative price level for them?
Well, if we're to believe the companies, because the companies, the wonderful investor relations departments who put out these wonderful presentations, they say that companies can make, the shale companies can make money producing shale oil at $40 a barrel. Well, it's at 75 now. And last week, in the beginning of after the holiday, it went from 67 to 70 in the 70s, 74, I think. Well, the Permian just dropped 5 rigs in the Permian. Why? If you're a company and you're seeing the oil price go up, why are you dropping rigs? There's a lot of dynamics that I could talk about that, because I really do a lot of research about the shale industry. I think the issue is that the low natural gas prices, the low NGLs are really impacting these companies. And so Exxon just said it. They're going to have much lower profits due to lower NGLs, natural gas liquids, and natural gas. And so I even they're shutting rigs down in gas rigs too. So they'll likely continue to do that even if the price goes up. And this is going to impact the shale gas and oil production. Unless we start seeing $80, $90 oil, I don't see them adding a lot of rigs. I really don't. And the problem is, lastly, Tom, these drilling locations these shale companies have in the Permian, Eagle Ford, the DJ Niobrara, and the Bakken, they're not unlimited. Now they've gone through a lot of their good reserves, and so they want to keep these. They want to be conservative with them. So this is another issue that they have. They didn't have that problem 5 years ago. Now they do.
Steve, considering the idea that the rig count is falling here, is the interest rates that these companies are facing also affecting their ability to just function at these current price levels?
Yeah, well, the companies say that they can produce shale oil at $40 a barrel, and so with the price of oil going up last week to from 67 to 75. They cut 5 oil rigs in the Permian. So why would they do that? Why would they be cutting rigs if they're it's a higher oil price? And so the issue is it's the low natural gas price and the low NGL price, and that's really impacting these shale companies. And so now going forward, we even see declining more declining shale gas rigs. And so at some point in time, that will turn around. They'll probably start adding, but I don't think they're going to be adding more rigs until the price of oil gets above 80. However, you mentioned the interest rates. Now, shale really wasn't economic unless you had zero interest rates, because they added a lot of debt. It wasn't economic. And so they added a lot of debt. Unfortunately, with the interest rates moving up, a lot of these companies don't pay down their debt. They have been able to pay down some of it. What happens when it comes due, they roll it over. Well, now if interest rates are going up, they're going to have to pay a higher rate. And so their interest expense goes up. And so this is another problem. And this is important to know too. When the pandemic hit, the shale companies didn't complete many wells, but they continued drilling them because it was cheap to do that. So they had this massive stockpile of, they call them DUCs, drilled but uncompleted wells. From the middle of 2020, towards the end of 2020 till recently, they have gone through about 4,000 of these DUCs. So they didn't have to drill them. They didn't have to count that as an expenditure. They just completed it. The completion is about 60% of the cost. So now they don't have those DUCs. So now if they're going to really have to ramp up production, they're going to have to drill and complete the well. So there's a lot of problems, higher interest rates, low natural gas prices. They don't have the DUC counts, and the reservoir depletion now is really starting to hit the Permian and these other shale fields. So I think they're going to start to get into trouble in the next several years.
Well, you mentioned the reservoir depletion here, and I want to get your take on what you make of these arguments that some people say that there is enough identified oil reserves to last us for at least the next 50 to 70 years. You know, Steve, you're a very strong proponent of this energy cliff. So I want to get your take on that.
Well, you see, not all reserves are the same. And I've read a lot of analysis on this. And one of the individuals that I follow is Jean Herrera, and he is the head of the ASPO France, is the American Society of Peak Oil. They're still doing strong over there. And he subscribes to my website. And so he's 93 years old, and he used to work in the oil industry as a geologist. He calls them realistic backdated reserves. The high quality reserves are about 770 billion barrels. The industry says we've got 1.7 trillion. So they estimate there's a trillion more. Well, that's a pretty big difference. They include Canadian oil sands. They include Venezuela heavy oil, and unfortunately, they also included a lot of the Middle East inflated oil reserves that are still on the books. So the problem is, let me just give you an example. Alberta oil sands production consumes, for every million barrels of oil sands they produce, they consume 1 billion cubic feet a day of natural gas. And they get that from their very close by shale gas field. Well, you have to have that shale gas to be able to heat up and process the oil sands. And so that's why the energy return on investment is so low for oil sands. It's about 4 to 1. Now, the problem is, when we understand that there are a lot of reserves out there, 1.7 trillion barrels, we have to know, and this is the way to simplify it. If I'm a simple farmer and have a family, or let's say a village, and there's all these fruit trees right next to us. Well, we went through all those fruit trees, and now we've grown and we need more fruit. We have to go further to get more natural fruit. Well, now you've got to go 4 or 5 days up the mountain to get the fruit. That's the energy return on investment's fallen. You've gone through that. Well, you can get it. By the time you get back, the energy that you have expanded to get that fruit is more than what the fruit's going to give you. Mm-hmm. This is the problem with the trillion barrels of these reserves. The energy is too great to get that energy out of the ground that is useful for this global high-tech economy that needs a much higher energy return on investment. That's really the nutshell. And then on the other side of the equation is all the debt that's propping up the system. When the energy starts to decline, that debt falls. The ability to have the asset falls also, and the capital to do more drilling and completing of wells also falls. This is why we have the energy cliff. And the oil industry does not understand that implosion of debt, how it's going to impact the global oil industry as well.
Mm-hmm. Steve, you mentioned earlier the SPR releases. And of course, we've seen, historic SPR releases over this period. Some would argue maybe unjustifiably because we weren't technically in a war situation. We were just combating these higher oil prices. What is your perspective on the SPR releases over this past, let's say, 18 to 24 months here?
Well, it was a one and done, unfortunately, and we have never seen anything like that. We've had some SPR releases in the 10, 20, maybe 30 million barrels. We've never done about 300 million barrels. And especially in the last little more than a year, it's 200 million barrels of oil were released. Well, that kept inventories in the world up. And that was good quality oil. That was medium grade oil. And what we're producing in the US is tight oil. So we're not going to, if we're going to put any of that oil back or build the SPR, we're not going to put tight oil. We're going to have to import that oil to put it in our SPR, but we're not going to do it. Because if we start doing it, then we're demand now. What used to be supply, and for a long period of time, it was about 1 million barrels a day months ago. That's how much between 750 to 1 million barrels a day was being sold into the market. That's supply. That's someone producing oil. Now, if we start buying, we become demand. I don't think we're ever going to do that again. And so, yes, this was a one and done, more political to keep the price, because I think the price of oil would have really went up in 122, 125 last year. It really went up. But I think that's going to come back to haunt us because we're not going to have another 300 million barrels to sell. We could sell more, which would be even worse if we did that. But we don't have the oil really to sell anymore. We do need at least 300 million barrels in there for the military. That's what it's supposed to be for, or any major disruptions.
So what's our inventory level now?
It's about 355 million barrels. I believe that's the number, 340, 350. And so if we use about 20 million barrels a day, that's what the US uses. So you figure 300 million barrels, that's a 15-day supply, 2 weeks, if we're going to use just the inventories.
And what's our historic inventory level?
We were well above 700 million barrels, well above 700 million barrels. So now we're less than half of what it was. And it's been really falling, tremendously falling.
How do you look at the markets to try to understand their direction based on, let's say, net short or long positions and separate out the commercials and non-commercials? Is this in a way almost like looking at the smart money versus dumb money index there?
It is, and Ted Butler talks about this. And so when you see a high commercial net short position in the metals, gold and silver, it tends to, and that's the commercials. The commercials, which are the bullion banks, if a speculator or a company is going to go long, there's got to be a short. That's just the way it is. So when the commercials have a large net short position, that tends to correlate with a high price. But when they have a very low, and this was back in, I think, November 2022, the commercials had actually a positive long position in silver. And that's when silver hit 18. So that's the low. And now it's been trending higher. And so you could look at those numbers, and they have kind of worked for decades. I see that working less when we head over the energy cliff, because the futures markets are going to become very disruptive because of where's the future supply could be very problematic. And so futures could be disruptive. And then we have the problem with collateral we've talked about, understanding what real collateral is. Even though gold and silver are traded as metals, they're traded more as commodities. The cost of production and supply and demand, they really should be also valued as money, which they're really not. And so that is going to transition as we head over the energy cliff. And so I've been looking at those fundamentals. And so it gives me an idea of where the lows are and where the highs are if we look at the cycles of gold and silver.
Returning to this idea of higher interest rates and that how that really starts to affect, let's say, companies and or economies. Is the debt servicing ability of nations with higher interest rates now markedly more difficult when we combine it with this energy production and return on investment?
Exactly. The scenario is so much different. And we go back to the 1970s. Even though the oil price went from $1.80 to $36 by 1980, due to the Middle East, we had the Saudi Arab oil embargo, and then we had the Iranian Revolution. Even with those impacting the United States, the oil price, oil supply globally increased 14 million barrels a day in that period of time. We don't have 14 more million barrels of growth. We may have a few, maybe a few. And so now the debt has exploded since the 1980s, especially since the global financial crisis. The global debt has doubled since 2008. It's over 300 trillion. And then you look at the interest rates now, you could increase interest rates. Paul Volcker could increase interest rates up to 15%, 18%, because there wasn't a lot of debt. You do that now, you get a $1 trillion+ interest expense for the US government. And they're going to have to print that money for that. So these are the dynamics, not only in the United States, it's going to be in Europe and even in China. China's in serious trouble. They printed a lot of money. And so, yeah, if you don't have the energy to grow and you just print money and more debt, this is really going to be stagflationary. And I'll tell you, investors are going to start waking up, especially very wise investors, institutions, and high net worth individuals. That's when I see the major inflow into these ETFs, as well as regular bullion. That's when I see it happening. It's not happening yet, but it's coming.
Mm-hmm. Do you think that move into ETFs really drives more production demand as well, Steve?
Production as in mine supply?
Mm-hmm.
Well, I think mine supply is separate, because even if we get a high gold price, let's say gold goes to $3,000, $4,000, you could see you could see more mining activity, especially small mining, but artesian mining. But the issue is going to be, even though you have a high gold price and you have lower oil production, you're just going to have less gold production. Maybe not initially if you get very high gold prices, but as oil production declines and declines and declines, you're just going to have less production. And so this is another factor that is very bullish for the metals, along with the energy cliff and the collapse of financial assets and real estate, is that you're going to have less supply of the metals. And so you put all these dynamics together. Again, Blackrock just put a very, I'm trying to think of what the number was. It's very little money in the PSLV. When we're talking it's a half of 1/100% of their holdings into silver. Mm-hmm. When you just get a 0.5% in some of these large institutions into silver, we're talking tripling of the silver price. And so this is the dynamic that's coming, because the stagflation is really going to hit, and the markets aren't prepared for that.
Mm-hmm. Well, Steve, I think that's an interesting point to kind of wrap up on for today. Is there anything else that you wanted to mention before we do?
No, I do think it's important that more people realize, even though they may not believe in peak oil, there'll be more believers. Kind of like a lot of people years ago, hundreds of years ago, thought the earth was flat, and the church even crucified Galileo for saying that the sun was the center of the solar system, not the earth. And so when we understand the future, when we see the dynamics really start to play out, the reality is really going to hit people. It's going to be the Carbonaro effect, and they're really not going to be prepared for this. And then you add any major geopolitical events or pandemic or any breakdowns, it just makes it worse. So I just want people to be prepared for it. I'm not trying to be alarmist. I'm just trying to show that these are the issues we're going to be facing. So people not only should be in precious metals, but they should be prepared for any disruptions in the markets as best they can. And that's up to each individual to do that. So I do appreciate you letting me share this information with your followers.
Always grateful for the chat, Steve, and you sharing this info with our listeners. And as well as being very generous with your subscriber only info. Which
Sure.
You cover a lot of this only for your subscribers. So I do appreciate that as well.
Thank you. Yeah, we do. We try to give out those details because, this analysis takes a lot of time. It's a full-time job. And so I do appreciate people who are willing to support that kind of work, because I couldn't do it unless I had that support. And so I think this, even though I don't know it all and I can be wrong. And the one thing, Tom, I could be a little bit off on the timing of the energy cliff, but I don't think the timing is off that much. And so, and you look at the debt that we have increased. So this is, I like to share this important information with people. And again, thanks for your time.
Thank you, Steve. And of course, all of it is available at SRSrocco.com. And of course, you're a great Twitter follow as well at SRSrocco Report.
Yeah, that's true. Thank
Wonderful,
you.
Steve. Thanks so much for your time today. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.